Hello everyone and welcome to Financial Accounting. In this video, we will discuss the Integrated Financial Statements Framework and how to use it to analyze, record, and summarize business transactions. I decided to record this video as I think that this approach will be very helpful to those who are not majoring in accounting or who are new to accounting and don't know or don't fully understand the rules of debit and credit. Let's first look at the accounting equation. It is used as the basis for the Integrated Financial Statements Framework. The accounting equation is expressed as follows: assets equal liabilities plus owners or stockholders' equity. The accounting equation applies to all transactions. If we expand the accounting equation as shown on the slide, an integrated financial statement approach can be designed to analyze, record, and summarize transactions. This can be done by including columns for the statement of cash flows, balance sheet, and income statement. The left-hand column on the slide shows the effects of transactions on the statement of cash flows. Each cash transaction is recorded and classified as an operating, investing, or financing activity. We will use it later to prepare the statement of cash flows. The statement of cash flows reports the change in financial condition due to the changes in cash during the period. The statement of cash flows is organized around the three business activities: operating, investing, and financing. Any changes in cash must be related to one or more of these activities. To learn more about operating, investing, and financing activities, watch my video called Business Activities. I'm posting the link here and in the description below. The cash at the beginning of the period, plus or minus the cash flows from operating, investing, and financing activities during the period, equals the end of the period cash. This end of the period cash amount is reported as an asset on the balance sheet. Therefore, the statement of cash flows is integrated with the balance sheet. The right-hand column on this slide shows the effects of transactions on the income statement. Each revenue and expense transaction is recorded and classified as a revenue or expense. We will use it later as a basis for preparing the income statement. The income statement reports the change in financial condition due to the company's operations for a certain period, such as a month, a quarter, or a year. The time period covered by the income statement may vary depending on the needs of stakeholders. Net income for the period, which is revenue less expenses, is added to beginning retained earnings. Therefore, revenue and expense transactions are also recorded under the retained earnings column of the balance sheet. By doing so, the balance sheet is integrated with the income statement. The balance sheet reports a company's financial condition as of a point of time, for example, as of the end of the year. I will record videos to show you several transactions and how the integrated financial statement approach is used for analyzing, recording, and summarizing each transaction. Make sure to subscribe so you don't miss the new videos. The integrated financial statement approach shown on this slide is instrumental for analyzing transactions and their effects on financial statements. It is also a huge help for analyzing and interpreting companies' financial statements. This is because significant trends or events may be missed or misinterpreted without understanding how a company's financial statements are integrated. Assume a company reports net income on the income statement. As a result, the income statement users might mistakenly conclude that the company's operations are successful and no significant changes are necessary. In fact, the company might be experiencing continued negative cash flows from operations and, therefore, be headed towards bankruptcy. This is why analyzing all the financial statements and their integration is essential. The integrated financial statement approach shown on this slide has built-in controls to ensure that all transactions are correctly analyzed, recorded, and summarized. These controls include the following. The accounting equation must balance, which means that assets must be equal to liabilities plus stockholders' equity. The ending cash on the statement of cash flows must equal the cash on the balance sheet. The net income on the income statement must equal the net effects of revenues and expenses on retained earnings. That's all for today. I hope you found this video helpful. If you did, please subscribe, hit that like button, and ring the notification bell so you are notified when we release more videos like this. Visit my channel for more videos on financial and intermediate accounting. Please leave comments and share this video with anyone interested in learning accounting. Thank you all so much for watching, and I hope to see you all again in the next video.